This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices higher this morning. In fact, overnight gains were met with follow-through strength in the morning hours here with better than expected economic reports here in the U.S. Also, we did have better than anticipated Chinese and Eurozone manufacturing data, all of which contributed to very good gains here in stock indices. We continue to believe that even though we have plenty of geopolitical problems, including the latest one yesterday up in Canada, will ultimately be overpowered by more central bank accommodation. In fact, we are already seeing that from the European Central Bank. This week, they initiated a bond purchase program. In fact, that started Monday. So we're already seeing more easy money coming from that part of the world. We also anticipate that the Fed will continue to be rather dovish in their comments, even though it is widely expected that at the October FOMC meeting, which will be at the end of this month, the Fed will make good on their promise to end the quantitative easing program. However, interest rates will remain very low for a very long period of time, I think much longer than most analysts are anticipating. In fact, even though the consensus view is for the Fed to raise rates in the third quarter of next year, our feeling is the Fed will not be in a position to do so, probably not until 2017, maybe 2016, it's hard to say, but I think that we are likely to see more accommodation coming from the Fed, not less, in the next year or so. So this bull market still appears to be intact in stock indices. Over in the currencies, as we mentioned, the ECB adding more stimulus. Had a bit of a negative over the last couple of days, but a bit of a rebound today with some better than expected Eurozone economic data. Seeing the pound weaker after UK retail sales coming in actually with a negative number, but also weaker than anticipated. We continue to believe that currencies will trade in a very broad trading range with breakouts failing in both directions in all of the currencies as interest rate differential outlooks tend to converge as opposed to expanding over the last year or so. However, that is all the more bullish for the credit markets as far as central banks leaning more toward the accommodation side. That should continue to support treasuries, especially the long end. We're looking at the 30-year bonds having very good support around the 140 area. I think that is an excellent area to start thinking about picking up some long positions in the 30-year bonds. Also, the bull market in treasuries, especially the long end, most likely will continue this year and well into next year. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
That's his favorite place. She was at the football game last night. 25 UVA.